Welcome to Ekesha's Foreign Exchange Made Easy class. Today is 8th session. Last day I have discussed currency risks, derivatives and underlying asset. Today I will discuss derivative products and it will be continued. Come to derivative products. Derivative products are forward, future, option, swap. Forward. A forward contract is a customized OTC over-the-counter contract between two parties to buy or sell an underlying asset at a specified price on a future date with quantity, quality and place also included in the terms. Two parties agree to conduct the said transaction in the future, hence the term is forward. The value of the forward contract is derived from the underlying asset value such as stock, commodities, currencies, etc. Currency forward. A forward exchange contract is an agreement under which a business unit agrees to buy or sell a certain amount of foreign currencies on a specific future date. By entering into this contract with a third party, bank or other authorized financial institute, the business unit can protect itself from subsequent fluctuations in foreign currency exchange rate. The intent of this contract is to hedge, that is to reduce the risk element. A foreign exchange position. To hedge a foreign exchange position in order to avoid a loss on a specific transaction. The cost of hedge includes a transaction fee payable to the third party. Hedges can generally be taken for up to 12 months in advance, although some of the major currency pairs can be hedged for a longer time frame. Salient feature of forward contract. Terms of the contract is tailored to suit the needs of the buyer and seller. Generally, no money changes hands when the contract is first negotiated and it is settled at maturity. Both parties are obliged to fulfill their contractual terms. Most of the contracts are held till the expiry date and the contracts can be cancelled only on mutually consent of both parties as it is a bipartite agreement. Generally, no cash transfer occurs when contract is signed. The seller of the commodity or underlying is obliged to deliver the commodity or underlying at maturity to the buyer and the buyer need to pay money at the same time and the buyer pays no money upfront except the transaction fees. Major limitation of forward contract. Counterparty risk, that is buyer or seller. There is an inherent credit or default risk since the counterparties of forward transaction may fail either to deliver the commodity, that is seller, or to pay the agreed price at maturity, that is buyer. Next, Liquidity risks. Since the terms of the contract are made according to the specific requirements of the parties, that is a tailor-made contract, other market participants may not be interested in these contracts. Since forwards are not listed for traded on exchange, it is difficult for other market participants to get easily accessed in these contracts or contracting parties. RBI guidelines for currency forward. Any Indian resident desiring to book forward contract should have an underlying trade contract which could establish exposure to foreign currency. The amount and tenor of the contract booked has to be equal or less the amount and tenor of the foreign exposure as suggested by the underlying trade contract. The market participant is expected to submit the trade contract to bank within 15 days of booking of the forward contract. Provision has been made to facilitate booking of forward contract by small and medium enterprises SME without submitting the underlying trade contracts. Settlement mechanism. Unlike currency future market, the settlement in OTC over-the-counter market happens by actual delivery of currency of goods. This is called gross settlement, where each counterparty exchange currency or goods traded on the maturity date of the contract. For example, in OTC spot market, suppose an exporter make a contract to sell $1 million to bank of USD INR at the rate of rupees 70.30 per dollar to be settled after 3 months. On the settlement date, the exporter will sell $1 million to bank and the bank will pay the exporter rupees 702 lakhs. This is a gross settlement where exchange of currency has been taken place. In OTC currency market, the settlement date is value date, which is different from the trade date, where two counterparties agree to a transaction with certain terms, that is currency price, the amount and value date. The settlement of the transaction happens when counterparties actually exchange currency on value date. The most important value date is spot value date, which is settled after 2 business days from the trade day, provided both center being open on that date. If one of them is closed, then the settlement will be on the next business day, that is on 3rd day or 4th day, etc. Any settlement date after spot value date is called forward value date, which are standardized into 1 month, 2 month, etc. after spot value date. The forward market can extend up to 1 year. If the settlement happens on trade date, the settlement price is called cash rate, and if it happens one day after the trade day, the price is called as TOM, that is tomorrow rate. The table below shows cash, TOM, tomorrow, spot and forward value. Trade day and cash date, T, that is trade. TOM tomorrow, T plus 1. Spot value date, T plus 2 business day. Forward date, 1 month, 2 month, up to 12 month. Suppose an Indian exporter made a contract with a bank to sell $10 million at a forward rate USD INR 70.20 in 6 months' time. The exporter is obliged to deliver $10 million to bank at the specified rate on the matured date, irrespective of exchange rate prevailing in the spot market at that time. If the prevailing rate on maturity day is favorable to exporter, say 70.50, still the exporter cannot deviate from the forward rate. He is bound to sell dollar at 70.20 as it is a contractual rate. In net settlement, market participants settle the transaction on the difference in value of goods or currency in cash. This type of settlement happens in future or option contract. For example, in currency future market, suppose an exporter sells $1 million after 1 month on USD INR future contract at the rate of 75.30. On termination of the contract, either on expiry or even before expiry, if the price of USD INR is 75.10, the exporter will receive the difference of 75.30 and 75.10, that is rupees 0.20 per dollar. That is, the exporter will receive 2 lakhs in cash, that is $1 million multiplied with rupees 0.20 per dollar is equal to rupees 2 lakh. As because the exporter will purchase USD at rupees 75.10 from market and sell it to bank as per contract at rupees 75.30, making a profit of rupees 0.20 per dollar. Problem. The following two quotes appear in the foreign exchange. Spot rate USD INR 46 and 46.25. 2 month forward 47.50. That is, premium is rupees 1 and 1.25. You add 1 to 46, you will get 47. And you add 1.25 to 46.25, you will get 47.50. Suppose the given premium is 1 and 0.75. That is, it is called discount. So you deduct 1 from 46, you will get 45, the forward rate. This is forward rate. This is forward rate. You will get 45 and you deduct 7.75 from 46.25, you will get 45.50. So if the premium is given, you add it, or discount is given, you deduct it from the spot rate. how many dollars should a farm to get rupees 25 lakhs after 2 months? Here the farm will sell dollar to bank and bank will buy dollar from the customer and the rate will be forward rate. So how many dollars, that is number of dollar, will be computed by rupees 25 lakhs divided by bid price 47. You will get the desired result. How many rupees is the farm required to pay to obtain USD 2 lakh in the spot market? Here the farm want to purchase USD 2 lakh at spot market. So the bank will use 46.25 ox rate, ox price, and multiplied it with the USD 2 lakh. So you will get the desired result, that is rupees will be required. Assume the farm has USD 69,000 in current account earning no interest. ROI on rupees investment, ROI means return on investment, is 10% per annum should the farm encash the USD now or 2 months later. Here are two propositions, that is, one is you encash the 69,000 USD on forward 2 month forward rate and you encash it at spot rate and invest it at the rate of 10% per annum for 2 months. So in these two alternatives, the amount where it is higher, that will be the acceptable. Now come the problem solved. The farm will sell dollar to get rupees 25 lakh after 2 months. Then we use bid rate, bid price after 2 months. So number of dollar required to get rupees 25 lakhs is equal to 25 lakh rupees 25 lakh divided by 47, that is equal to $53,191.48. You want to buy USD 2 lakh in the spot market. The rate is rupees 46.25 per dollar. This is ox price. Total fund required in INR to purchase 2 lakh dollar is equal to 2 lakh into 46.25 is equal to rupees 92.50 lakhs. After 2 months, the customer will get, that is encash $69,000 by forward rate, that is rupees 47 per dollar. It comes to 32.43 lakhs. Encash in spot, that will be $69,000 multiplied with rupees 46 by the bid price is equal to 31.74 lakhs. Add interest for 2 months at the rate of 10% per annum is equal to rupees 529 lakhs. You add these two, you will get 32.269 lakhs. So dollar will be encashed after 2 months because the encash amount after 2 months is 32.43 lakhs and encash amount in the spot and investment, this comes to rupees 32.269 lakhs. So it will be encashed after 2 months. Next problem, the price of a bond just before a year of maturity is $6,000. Its redemption value is $6,250 at the end of said year period. Interest paid is $450 per annum. The dollar appreciated by 3% during the said period. Calculating the rate of return. If the investor is US dollar, then there will be no impact of appreciation in dollar. If the investor is from any country other than USA, say India, then there will be impact of dollar appreciation on his return. Rate of return is equal to redemption money minus price plus interest divided by price into 100. That is equal to 6,250 minus 6,000 plus 450 divided by 6,000 into 100 is equal to 11.67%. If dollar appreciate by 3%, then return or for non-US investors shall be 11.67% into 1.03% is equal to 12.02%. Alternatively, it can be also considered that dollar appreciation will be applicable to the amount of principal as well as interest. Then it comes to 1 plus 0.1167 into 1 plus 0.03 minus 1 is equal to 15.02%. Future. A future contract is similar to a forward, except the deal is made through an organized and regulated exchange rather than being negotiated directly between two parties. That is, we may say futures are exchange traded forward contracts. A future contract is a legally binding agreement between the buyer and the seller entered on an exchange to buy or sell a specified amount of an underlying at a certain time in the future for a price agreed today. The buyer enters into an obligation to buy and seller is obliged to sell on a specific date. Futures are standardized in terms of size, quantity, grade and time, so that each contract traded on the exchange has the same specification. Contracts are settled in cash. However, in certain cases, they are settled in physically on expiration date. Margins and mark-to-market are applicable for such contracts. Margin here, initial margin, that is to be paid by buyer and seller both before entering into future contracts. It is mandatory. Mark to market is gain or loss of the buyer or seller daily basis, depending upon the fluctuation of currency rate or underlying prices. The loser has to pay the amount to the gainer through the mark to market account. These marginal and mark to market are applicable to all future contracts. Settlement agreement is provided by the clearing corporation of the exchange. When the underlying asset is commodity, namely oil or wheat, etc., the contract is termed as a commodity future contract. When the underlying asset is an exchange rate, the contract is termed as currency future contract. By means of future contract, hedger can eliminate the risks which they face with the movement of underlying prices, that is currency, in their business transaction like exporter, importer. Speculator or trader buy or sell underlying asset like currency in future contract with a view to take risks for profit or loss depending upon the movement of currency rate. The role of hedger is to eliminate or reduce the risks. of those who are undergoing underlining risks in buying or selling asset, which the hedger managed to offload it by passing to the speculator or trader, who takes risks for their profit or loss depending upon the movement of underlying asset rates. So, without actively participation of speculator, the hedger cannot be successful. Contract specification in future derivative market is given below. Specification explanation with example. Lot or contract size. Lot size is minimum standardized quantity of stock or derivatives per contract, that is 1 lakh consists currency derivative of 1700 etc. Contract size is number of lot multiplied with lot size. Now come lot contract size. In the future contract, transaction will be on in lot or and contract size, which is a standard quantity of security. The equity stock market. The size of the lot in stock market is determined by the exchange and it differs from one stock to other. For instance, for Reliance Industry, a lot size is 250 RIL, Reliance Industries Limited shares, and for Infosys and TCS, a lot size is 300 share. In both cases, the contract size will be as specified by the exchange, minimum value of rupees 5 lakhs. Currency future. USD 1000 one lot for USD INR. Euro 1000 is one lot for Euro INR. GBP 1000 for GBP INR 1 lot, JPY 1 lakh for JPY INR 1 lot. If the contract is USD 5000, then it will be 5 lot. 5 into 1000, that is equal to USD 5000, $5,000. The contract will be quoted in rupee term, however, outstanding position would be in USD, Euro, GBP and JPY terms for USD INR, Euro INR, GBP INR and JPY INR contracts respectively. Commodity future. Lot size of crude oil is 100 barrels. Each barrel is equal to 42 gallons. Gold 1 kg, silver 30 kg, wheat 10 metric ton. Trading cycle, stock market. 3-month trading cycle. The near month 1 month, the next month is 2 months and the far month is 3 months. New contract is introduced on next trading day following the expiry of near month contract. Currency future. Maximum 12 calendar month from current calendar month. New contract will be introduced following the expiry of current month contract. You should remember this. In future market, the exchange decides all the terms of the contract other than price. There are 2 positions that could be taken in a future contract. Number 1 is long position, number 2 short position, long position. When one enters into a future contract to buy the goods or currency at the future price F, then it means taking a long position. A trader takes a long position in the future when he expects the market to go up. He will gain if the future price at maturity is higher than the spot future price, and the transaction will take place in the form of cash. He will lose when the future price at maturity is less than the spot future price, and he will pay the amount in cash to the counterparty. The trading activity is the trader will buy the underlying security at the contract price and sell it at market price on maturity. Thus, if the future price on maturity is higher than the spot future price, he will gain, otherwise he lose in this deal. For example, a person has purchased at spot a future contract USD INR at rupees 48.50 per dollar after 3 months for a lot of $1,000. After 3 months, that is on maturity, the spot future price of USD become rupees 50.50 per dollar. Here you will make a profit of rupees 2 per dollar, as because he will buy at rupees 48.50 as per contract and sell it at rupees 50.50 per dollar in the market. The total profit will be $1,000 one lot multiplied with rupees 2 per dollar, that is equal to rupees 2000. After 3 months, if the future price is rupees 46.50 per dollar, then he will incur a loss of rupees 2000, as he will buy dollar at rupees 48.50 and sell it at 46.50. So loss will be $1,000 multiplied with rupees 2 per dollar is equal to rupees 2000. For example, if 1 month Nifty future contract is trading at 17,800 and a trader expects at the maturity of the 1 month contract would be settled at a higher level than this, he would take long position in index future at a level of 17,800. On maturity, if the market go up, that is index on maturity settle beyond 17,800, the trader will gain to the extent of the difference between the buy price and sell price or settlement price of the index. Short position. When one enters into future contract to sell goods or currency at a future price, then it means taking a short position. A trader takes a short position when he expects market to go down. He will gain if the future price at maturity is less than the spot future price, and he will receive the profit from the counterparty in the form of cash. He will lose when the future price at maturity is higher than the spot future price, and he will pay the amount in cash to the counterparty. The trading activity is the trader will buy the underlying security at market price, which is lower than the contract price, and sell it at contract price on maturity. Thus, if future price on maturity is less than the spot future price, he will gain, otherwise he will lose in this deal. For example, a person sells at spot a future contract of USD INR at rupees 50.50 per dollar after 3 months for a lot of $1,000. After 3 months, the spot future price of USD becomes rupees 48.50 per dollar, he will make a profit of rupees 2 per dollar, as because he will buy a dollar of rupees at the rate of rupees 48.50 from the market and sell it at rupees 50.50 per dollar to the buyer as per contract. The total profit will be for a lot of $1,000 will be $1,000 multiplied with rupees 2 per dollar is equal to rupees 2,000. In case the future price is rupees 52.50, then he will incur a loss of rupees 2,000. Note, on the expiry of future contracts, the resulting profit or loss is settled in cash. Today, I stop here. Next day, I will continue derivative future. Thank you.